Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about strangles, and in particular, we're going to be talking about equidistant versus delta-neutral strangles. A short strangle, and we're going to talk about short strangles in this case, so basically an income strategy where we want to profit from the non-movement of the stock or a decline in implied volatility. It's made up of a short call and a short put that are usually out of the money. So at the money is in between them. And like I said, benefits from non-movement in the stock price, and at the same time, it also benefits from the decline in implied volatility. Short strangles are usually put on when there is either a very high value of implied volatility because you're going to get a high credit for the call and the put because they're going to be inflated with a higher value of IV, or when you expect the stock to stay in a range. So if you think that it's going to move sideways and that it's going to be range bound, then you would put on a short strangle and you would take advantage of that. You would take advantage of time decay because that's going to work in your favor, and you're going to be hurt by a big move in either direction. So this is basically what a short strangle is. The long strangle would be the opposite. So most of the principles that we're going to talk about here apply in a similar way, but in reverse. So we talked about equidistant and delta neutral strangles. So most traders, when they put on a strangle, the logical thing to do would be to think that if the price is at a certain point and you would sell a call a certain distance away from the current price, and you would sell a put the same distance away from the current price, they would get a delta neutral strangle and a strategy that doesn't have a directional component. However, if we take a look and we go deeper into the details of how the options are priced, you're going to notice that if the strikes are equidistant from the at the money, for example, we know that the strangle is a short put and a short call. The delta of the strangle is going to be the delta of one and plus the delta of the other one. So the delta of the short put plus the delta of the short call. But if we know that we have a volatility skew and we have the at the money, so this is a real example. This is Apple at 275. So this is the at the money. And if we go the same distance away from the at the money, you're going to get a put that you're going to sell that is going to be a certain distance away. And the same distance away to the upside, we're going to sell the call. So this is an equidistant strangle. Right away, you're going to notice that you're going to be selling low IV here and you're going to be selling high IV here. So because you're going to be selling large negative deltas, you're going to have large positive deltas. Here, you're going to be selling positive deltas, so you're going to have negative deltas that are less or smaller in value than the ones that you're selling with the put. So the strangle that you're going to get is going to be is going to have a directional component, and is going to have a positive directional component, which might not be what you wanted because you probably wanted to have a position with no directional component, a position that only benefits from either time passing, so theta, or implied volatility going down, so vega in that case. So equidistant, so this triangle is equidistant, but we know that the delta of the strangle is not going to be zero because those values are going to be different. This one is going to be higher delta, higher value, higher implied volatility, and this one's going to be lower delta, lower value, lower implied volatility. So this is going to be a strangle that's not balanced and that's not delta neutral. So if we put on the position that we talked about, in this case, Apple was 275. If we go to the 230 and the 320 put and call respectively, what you're going to get is a put that's a little bit larger. So it's going to give us a positive delta to the strangle. And we probably didn't want that. We wanted a delta neutral strangle. We wanted a strangle that doesn't have a directional component. If we look at the expiration line here, and we also take a look at the T+1 line, you can see that it's a little bit off center. This is the price right now. It's a little bit off center to the right. So the whole position is going to benefit the most if price moves higher. So, which is a weird thing, because you probably wanted the price to stay exactly the same. This position wants the price to go higher, so it has a directional component. It's not a delta neutral strategy, which is fine if that's what you want. But if you wanted a perfectly balanced short strangle, then you are going to be trying to construct a strategy that doesn't have a directional component on it. Now, what if we pick, instead of looking at the distance between the option and the current price, if instead of that, we select both options to have the same value of delta, absolute value. So I'm not looking at signs here, just the same absolute value of delta. Now we're going to pick a short call here and the short put with the same delta. Then it's the same thing. The strangle is going to be the short put plus the short call. The deltas are going to be the sum of them. And we're going to sell the same call. But when we sell the same, the put, that's the same distance away from the at the money. Instead of that, we're going to have to push it to a lower strike so that the deltas are the same for the call and the put. Once we do that and we analyze that, so we know that the delta of the strangle is going to be 0 or very, very close to 0. It's very rare that you get a position where the delta is exactly 0, but you should aim at being very, very close to 0. And that would be a delta neutral strangle, which is probably what you wanted to begin with. So this is now the same strangle, but with the put being selected with the same delta of the call. So instead of the 320 to 30, now we sold the 320 to 25. So we moved the put to a lower strike so that it has a lower value. It has the same value of, it has the same high value of implied volatility probably, but because it's going to be further away from the at the money, the deltas are going to equalize between the call and the put. And now, as you can see here, it's more centered and it's more balanced, and it's what we would consider a delta neutral strangle now. Now you want price to stay exactly the same, and you're just going to be betting on the passage of time beating out the move in the underlying, and also if there is a decrease in implied volatility, you're going to be benefiting from that too. This is what we would call a delta neutral strangle. So to summarize, instead of when you put on a strangle, and this is the same thing for traders who want to put on a long strangle, but it would be the opposite. They would be trying to hope for a big move in the underlying or an increase in implied volatility. But if we talk about strangles, instead of going to the current price and going the same distance away from the current price for calls and puts, instead of doing that, what you should do is, if you want perfect delta neutrality, what you want to do is pick the call and the put to sell if you want the short strangle, or to buy if you want the long strangle, that have the same value of delta, not the same distance, because the skew is going to make deltas not be equidistant for the same values. Now we're going to take a look at another example in the trading platform, and we're going to do the whole analysis so that you know what to do and what to look for when you're trying to put on a strangle, and if you want, especially if you want the strangle to be delta neutral. So now we're on a trading platform. We're going to take a look at an example. We're going to take a look at the SPY, which is the ETF that represents the price of the S&P 500. The reason why I picked the SPY is because usually equity indices display a very heavy amount, a very large amount of volatility skew, and it's going to be good for us to see what the difference in Strangles is when we pick an equidistant versus a delta neutral strangle. So in this case, what we're gonna do is we're gonna open up the May, so you can see the IV skew here. It's very high on the puts, so very high on lower strikes. It goes much lower on the higher strikes, and then it picks back up right at the extreme of the high strikes. So let's take a look at the May expiration, which is the next monthly one. And we know that it's trading at $280. So what we're gonna do is I'm going to be picking a so this is the at the money. So I'm gonna go let's say $50 out of the money on the puts. So I'm gonna be selling the 230 put, and I need to buy the 330 call, which is this one. Okay, so 230, 330, it's equidistant. I'm picking up $1.24, and let's take a look and see what this looks like. So now we're here analyzing the trade that we just put on, the 230, 330 strangle. This is an equidistant strangle, but as you can tell, it's not a delta neutral strangle. This whole position wants the price of the underlying to go higher, actually much higher. We start playing with the days here and we start simulating time passing. You want the price, the max profit is going to be at $291, $292 when this this underlying is trading at 280. So you want the underlying to go higher, but you thought because it was an equidistant strangle, that's as far away on the call as it is on the put, you thought that it was going to be neutral, and it's not. So this is one of the things that a lot of traders don't realize, that just because the distance is the same, the delta itself is not going to be the same. So if you're okay with having a position that you want, where you want the price to go higher, then you're fine using this kind of structure. But if you want a position that's really delta neutral, well, you wanna make adjustments to this so that you have a delta neutral strategy. So what we're gonna do here is, now that we know that this one is delta positive, we're going to go back to the options chain, and we're gonna take a look at what's going on. So the 230, 330, the 230 has 7 deltas. The 230 put and the 330 call has 1 delta. This is the reason why this is heavily directional. Now, one of the things we could do is, well, let's make the deltas equal. So I could either move the put further, so it's going to be higher here, or I could also move the call to a lower strike, so higher on this chain. So I'm gonna do the second, just because I want to have some deltas and I want to have some value. Here I'm picking up only 125. I want to pick up a little bit more credit so that the trade makes sense for the risks that I'm taking. So let's take a look. So we want 7 deltas. So you wanna go for the 309 call. So instead of the 230, 330 like here, we're going to go for the 230, 309 in this case. Okay, so let's go back to our Analyze tab. And instead of the 230, 330, we're gonna open up the price. So it picks up the current one. Let's not worry about this right now. And let's go for the 230, 309. Okay, that should make the deltas very close to each other. So as you can tell now, the strangle is not symmetrical, but the delta is a neutral delta. Look here, we have exactly 0 delta for the whole trade. So the price is here. Now we don't want the price to go higher because we'll be losing money. We want the price to stay exactly the same. So if I start playing with the days, I'm gonna go back, but now I'm gonna go forward. So this is today. This is today, and as time passes now, you can see that the max profit is always at this price. So it's a delta neutral strangle. This is, as you can tell, the 280 is the price, and we're selling the 309, so right about here, and the 230, so it's very asymmetrical. It's larger on the put side because the IV is higher on the put side. But the delta is very close to 0, basically almost negligible, so 0 for all intents and purposes. So now you can see the difference between an equidistant strangle and a delta neutral strangle. So to sum up, when you want to put on a strangle and you want it to be delta neutral, instead of seeing where the price is, in this case 280 for example, and going 10 up and 10 down, you shouldn't do that. What you should do is, okay, so I want a delta neutral strangle, then I'm gonna sell the 30 delta on both sides. So you go and look at the delta column. In this case, I have it right here. So you look for the 30 delta, for example. In this case, it would be 266. And look for the same 30 delta in the calls. There is no 30 delta, but the 31 or 29, either one is fine. So let's pick the 31. So 292. So the 292, 266 would be a delta neutral strangle. Don't worry about the 266 being $14 away from the at the money, and the 292 being only $12 away from the at the money. Don't worry about that. If you want to make a delta neutral, your strangle is probably not going to be symmetrical unless the skew is flatter and almost completely flat. If you don't have a flat IV structure, IV skew structure, then you're going to have this situation where your strangle is not going to be symmetrical, but it's going to be delta neutral. So I hope the concept was clear with the explanation, and I hope you guys can use this information and apply it in your own trading. Hope to see you guys again next time. Thank you. Goodbye.